Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, January 31st. Hope you guys are having a great day today. We got a lot to kind of go over, so we're going to kind of jump right into it. We'll start off, of course, every week we get every Thursday we get the initial jobless claims, so we'll start off with that. So last week was revised a little bit higher. We had 200,000 people apply for unemployment. Now, forecast is supposed to be in the 216 range, but it exceeded that by 253,000 here. Now, this is obviously unusual. We get these biggest swings in here, but a lot of this, right around the holidays, we get sometimes obscure hits and misses, primarily because we get seasonal, and sometimes that plays a role into it. Now, some people may think it might be the federal, but most likely it's not. There might be a small percentage or a very small amount that might be from the private sector that worked with the government that with the government shutdown affected them. They may have, but the government employees have another avenue where they go through the federal level where they can pull that money or request for like initial jobless claims type of thing. But those won't count against these numbers here. So most of this, probably most likely, it was seasonal, and you'll probably see this start fading as we get away from the holiday season here. But yeah, typically right around this time period, we do see some numbers that can fluctuate a little bit due to the season with people getting jobs for Christmas, and then when that Christmas and that's over, then those jobs are no longer required. The next item here is the employment cost index for the fourth quarter. So the previous reporting came in at, for third quarter, came in at 0.8%. So I figured it would cost about 0.8% again, and it went up to 0.7%. So this raised our annual from 2.8 to 2.9%. This is the fastest jump we've had in like 11 years. So this is kind of inflationary data, and this used to be Alan Greenspan's favorite gauge for inflation because this shows that people are making more money. And this is obviously a good thing that people are making more money. So that's a good sign there. But again, we got to watch the inflation data because that's what the Fed watches, and that's the reason why they raise interest rates to slow it down a little bit. Now we got Chicago PMI. This is manufacturing in the Chicago region. We've already had New York, which came in. I believe New York was poor, and then but Philadelphia came in pretty good. Now Chicago, as you can see, it dipped a little bit here. We had 65.4 back in December, but it dipped a little bit in January down to 56.7. Again, manufacturing is something we'll watch, but sometimes we have these ups and downs during the course. How things, especially with the weather and stuff like that, could maybe play a factor in there. Last but not least, what's released today is we got the new home sales for the month of November. So back in October, we had 562,000. Forecast for November was supposed to be 563, and it jumped way up to 657 new home sales. So pretty big, dramatic increase in new homes. Now we had other reports that were due today, but due to the government shutdown, some of these reports will be delayed. Like a big one that was going to be reported today was the PCE. This is the Fed's favorite gauge for inflation. This won't be released. This will probably most likely released next week. A lot of the reports that were delayed will probably move, over the course of time will be released shortly after. But again, this is what we're seeing right now. And let's move ahead to headline news. So the stock market is a little mixed. Dow's the only one that's down so far. S&P and Nasdaq are both up. We got Q4 earnings reports. They're doing pretty well, not too bad. But sometimes they just take a little bit of a break. Like the Dow might be taking a bit of a break after the big, huge run up yesterday after the Fed announcement. Came in, if you missed it, the Fed did. It came in pretty dovish. They basically removed the wording from gradual rate increases, rate hikes, to basically now they kind of have it that we might be at the end of our rate hike cycle. So that's a good news for investors. They like that, obviously, that they of course are repeating what everybody else kind of knows is the global economic slowdown. China slowing down. We have trade negotiations going on between U.S. and China, and that's obviously affecting China's economy. Europe is kind of bringing in some poor numbers, so we're kind of we're also intertwined that at some point it will kind of hit us a little bit more, and so they're kind of doing that. And they also basically mentioned that the balance sheet is when the time comes or if it's needed, they will go ahead and adjust the trade balance sheet reduction plan, known as QT, that could be also adjusted at that time period as well. But their major tool to fight, the economy and keep us stimulated will be interest rates. So part of the reason why they want to raise this up so fast is that if we do run into this situation, they have no ammo to work with, and and of course we don't want to go to negative interest rates. So at least we could start reducing the interest rates if need be. So let's see how bonds are playing out today. Bonds are doing quite well. Oops, sorry about that. They're up about 20 basis points. So we had a nice little rally yesterday. So you should see a pretty nice rate sheet rate improvement or pricing index improvement. Now, typically it takes about a quarter of a point to make any difference in the interest rate to make it like 1/8 of a difference. So when I say improvement, you might see about 1/8 to 1/4% difference in rate improvement here so far. Now we're here. You gotta be a little cautious. We got this next level. It's a pretty, as you can see, it's almost a double ceiling of Fibonacci levels here. We're reaching the top here, and tomorrow we got the jobs numbers, and we're kind of expecting a kind of a big number here that could spark the stock market. So if that sparks the stock market, that's going to pull money out of the bond market and bring this down. So we could eventually bring this right back down to this level here, and that's a pretty big drop as well. So that could bring us back down in 1/8 or 1/4% in our rate. So just be a little cautious if you're out there. If you got interest rates floating, you might want to kind of block ahead of the job numbers tomorrow, because if it is as big as what they're kind of thinking, that could spark the stock market. Let's see how this is playing on the bond market and the treasuries. Treasuries are down. They're down to about 2.65, I believe it is. And again, they got a little bit of room down here, but the good thing for us is that it's still below the 25-day moving average, and that's keeping a lid on pressuring interest rates from going up. So this is kind of helping us out. So we got more room, obviously, to the downside and help us out interest rate wise. So again, interest rates improvement today. If anything changes or any updates, I'll go ahead and I'll post on Twitter. You can follow me at Mike Bjork if you want to get those updates. You guys have a great rest of your day. Thanks so much for watching. We'll see you guys tomorrow. Bye-bye.